Okay, let's unpack this. Imagine you're trying to price something incredibly complex, like, say, a custom-built rocket, right? Before 2007, financial institutions pretty much used a classic formula, the Black-Scholes-Merton model. It was like this universal blueprint for valuing derivatives. Elegant, widely accepted, assumed a fairly stable financial world. But then the credit crisis hit hard. And suddenly, that blueprint started looking maybe a little too simple, a bit naive even. Today, we're doing a deep dive into the fascinating, sometimes really mind-bending world of XVA valuation adjustments. And these aren't just, minor tweaks. They're a huge paradigm shift in how derivative contracts are priced, how they're understood. We'll be digging into various sources, including Andrew Green's big book, XVA, credit funding and capital valuation adjustments, to figure out why these adjustments happen, what they actually mean, and why they're now, well, absolutely central to getting derivative pricing right. Think of this as your shortcut, yeah, getting you up to speed on this complex but crucial part of modern finance.
What's really fascinating here is we're looking at a world where that old idea, the law of one price, identical things should cost the same. It just doesn't quite hold for derivatives anymore, not universally. We're going to see how things like credit risk, funding costs, even regulatory capital,
Yeah.
stuff that used to be kind of on the sidelines, how they've moved front and center, absolutely crucial for accurate pricing now. So this deep dive, it should give you a really clear path through the complex forces that reshape the markets. And the sophisticated models needed now. Hopefully you'll get those aha moments without the information overload.
It's quite a transformation, isn't it? Before the crisis, derivative pricing felt, I don't know, relatively straightforward. Maybe that's the wrong word, but we're talking like 1996, the Basel I era, pre-2007, counterparty credit risk, handled with traditional credit limits mostly, and capital management. Yeah, that felt like a back office function, a chore almost. Discounting was there, sure, often multi-currency, but a bank-specific funding costs. They weren't explicitly part of the valuation radar. Not really.
Yeah.
Exactly. And if you connect that to the bigger picture, the crisis just blew massive holes in that traditional Black-Scholes framework. It exposed the gaps. Post-2007, perceptions of bank creditworthiness, they just shifted dramatically. Funding spreads widened, a lot. So suddenly, unsecured funding costs became this major focus. Couldn't ignore it. And regulatory capital, like you said, no longer a back office thing. It became this scarce, expensive resource managed actively right in the front office, driven by new rules like Basel, Title V, Basel III. It really makes you wonder, though, doesn't it? If these costs were always there, fundamentally, why did it take a crisis for them to become so central to valuation?
It does make you wonder. It really does. This huge shift meant that the baseline risk-neutral valuation, the one assuming no credit risk, no specific funding costs, it just wasn't enough anymore. It was like trying to price that custom rocket just based on raw materials, ignoring the engineers, the special equipment, the launch insurance, just the metal. It doesn't work. So given all these changes, how do our sources describe the full anatomy of a derivative price today? For an unsecured trade, say, what's actually in that price tag now?
Well, for an unsecured trade, the price now includes several distinct layers. You've got the basic risk-neutral value, sure. Then you add hedging and management costs. And then the whole XVA suite, CVA, FVA, KVA. Often some profit element, too, like TVA. And for collateralized trades, even more nuances there. And look, these adjustments, CVA, DVA, FVA, MVA, KVA, they're not minor. They fundamentally redefine the economic reality. You can think of them as adding layers of realism, financial realism, accounting for all those real-world frictions and costs the old models kind of glossed over.
Okay, let's really zoom in then. First pair, CVA and DVA. Credit valuation adjustment, CVA, that's the risk to your counterparty defaults, right? And then DVA, debit valuation adjustment, the risk that your own bank might default, the flip side.
Exactly. And what's fascinating here is the symmetry problem, or lack thereof. If two parties only look at the risk of the other side defaulting that's unilateral CVA well, they're never going to agree on the price. The values won't match.
Yeah.
So introducing bilateral models, CVA and DVA, was meant to fix that, restore symmetry. But DVA caused controversy because the implication is if your bank's credit gets worse, your DVA goes up, and that could lead to an accounting gain, which feels deeply counterintuitive to a lot of people. Profiting from your own perceived weakness, it doesn't sit right, does it? So the first big takeaway, a derivative's value, it's not universal. It truly depends on both parties' credit standing. Shatters that law of one price right there.
That does seem like a paradox, making money because you look riskier. So how do banks try to actually mitigate these credit risks in practice?
Right. Critically, counterparty risk is always present. Always. Even with the strongest collateral agreements, the CSA's credit support annexes, the CSAs reduce the exposure. drastically sometimes, but they're not perfect. Never totally perfect. Think about the practical stuff. Minimum transfer amounts, maybe non-zero thresholds before collateral even moves, grace periods for payments. And our sources really highlight this margin period of risk under Basel III. It's this like 10, 20-day window where if a counterparty defaults, the rules assume no new collateral gets transferred during that time, despite the agreement. That little window, it can represent huge potential exposure. And we saw it right. Lehman Brothers took years to unwind. Shows you the real-world messiness.
Okay, so if the risk is always lurking, even with collateral, how is CVA actually managed inside a bank? Is it trade by trade?
Oh, that's a key point. No, it's typically calculated and managed at the counterparty level, not per trade. And that's crucial because of netting rules. Banks can aggregate all the eligible trades with one counterparty, treat it as a single net exposure, which massively changes the calculated risk compared to looking trade by trade. And that's fundamentally different from how market risk is often managed, aligned by asset class rates, FX equity. CVA cuts across all asset classes for a single counterparty, which, raises the question, how do you efficiently manage that kind of diverse cross-asset risk bundle? It's a big organizational and data headache.
Right, I see. So with credit risk firmly in the spotlight, another massive post-crisis factor was funding. Let's talk FVA, funding valuation adjustment. This is about the explicit cost of funding unsecured derivative trades. And our sources mention some pretty heated debates here, especially from academics like Hull and White.
Oh yeah, Hull and White, their arguments were rooted in classic finance theory. Risk-neutral valuation, Modigliani-Miller, stuff that often assumes these perfect, complete markets. In that world, maybe your own funding costs shouldn't impact valuation because you can supposedly hedge everything perfectly. But here's the critical takeaway, the reality check. Markets are incomplete, fundamentally. There isn't a big liquid repo market for derivatives like there is for bonds. You can't just easily fund your derivative book by repoing it out. So that makes a bank's own funding cost a very real, very distinct cost. A cost practitioners simply couldn't ignore despite the academic debate. It means your bank's funding profile. It directly hits the derivative's value. Period.
So FVA just became a practical necessity then, even with the theoretical arguments. Okay, so what exactly does FVA capture?
Basically, FVA is the spread. The difference between the bank's actual funding cost and some theoretical risk-free rate like OIS, so very much a trading valuation, reflects the real cost of doing the trade for that bank. And it also throws up this potential issue of double counting benefits, especially if you're using bilateral CVA. Because DVA and FVA are often driven by the same thing, perceptions of the bank's own creditworthiness. It's a subtle point, but it really affects valuation symmetry. And again, makes the value super specific to the bank itself.
Are there other funding costs we need to think about beyond just the unsecured FVA?
Oh, absolutely. Beyond FVA, for unsecured trades, you've got MVA margin valuation adjustment. That's the cost of funding the initial margin you have to post, either to CCPs or in bilateral deals. And then there are funding costs tied to liquidity buffers, volatility buffers, especially the ones linked to rating downgrade triggers and contracts, because those buffers tie up liquid assets, stuff you can't rehypothecate, can't reuse, that generates additional FVA. So yeah, it just adds more layers to the true cost picture, makes it even more institution specific, a hidden cost layer that wasn't really priced before.
Right. Next up, KVA, Capital Valuation Adjustment. This sounds like it's all about regulatory capital rules hitting the price tag. So capital, which we said was back office, now it's right there on the front line, impacting the price.
That's spot on. Post-crisis, regulatory capital isn't just a compliance checkbox. It's scarce. It's expensive. Banks have to manage it super carefully, and the cost of holding that capital has to be priced into new trades to see if they're even profitable. Basel III, for instance, brought huge changes. Higher capital levels, yes, but also a whole new capital charge just for CVA, risk to CVA of AR. So the natural question is, how does this cost of capital actually show up in the derivative's value? It's not just an overhead anymore. It's a direct input.
And how big are these KVA charges compared to CVA or FVA, for example?
Our sources suggest KVA is broadly in the same ballpark. Similar magnitude to CVA, DVA, FVA, so pretty substantial. The really critical part of calculating KVA is figuring out the expected capital requirement profile over the entire life of the derivative. Not easy. And the cost of capital itself, the return shareholders demand, it's often very specific to the bank, idiosyncratic. Varies by bank, even by business line. It's driven by their target return on equity. So it's another major factor making valuations unique to the institution holding the trade. Breaks that one price rule again.
This sounds incredibly complex to calculate, all these interacting adjustments. CVA, FVA, KVA, how on earth do banks actually do these calculations?
Well, the short answer is Monte Carlo simulations. overwhelmingly. Stepping back, Monte Carlo becomes pretty much essential. Why? Because of the sheer scale, the dimensionality of these derivative portfolios, and the complexity of netting sets. They can bundle almost any type of derivative across different currencies, different asset classes, your traditional analytical formulas or PDE solvers. They just can't handle that kind of scale and diversity. Think about predicting the weather, like you said earlier, but for finance, across thousands of instruments, over decades, you need simulation, billions of paths. Plus, these calculations are path-dependent. The value later on depends on how rates, spreads, everything evolves over time. Requires multi-step simulation.
That makes perfect sense. The scale is just immense. But what are the practical hurdles? Implementing these powerful simulations must be incredibly resource intensive.
Oh, it is. Hugely. The computational cost is massive. One big challenge is calibration. Do you feed the models historical data or market-implied data from options prices? Maybe historical for internal risk checks, but for consistent valuation, for accounting, for regulators, you generally need that risk-neutral market-implied calibration. And the other challenge is exactly what you said, the compute cost. XVA systems need enormous amounts of market data, constantly updated, and they need serious processing power. We're talking vast infrastructure, CPU farms, or increasingly GPUs, graphics processing units, thousands of cores working in parallel. Thus, to crunch the numbers, it's a major tech investment.
Wow. So with all that power needed, what does it mean for the actual financial models used inside the simulations?
Yeah, it often means using hybrid models. So while an individual derivative, like a complex option, might use a very sophisticated asset-specific pricing model on its own, when you're doing the portfolio-wide XVA calculation across all asset classes, all currencies, you often need simpler, more generalized models inside the Monte Carlo framework, just to keep it tractable, computationally feasible. So there's this inherent trade-off, right, between model sophistication for individual products and the need for speed and consistency across the whole massive portfolio. It's a balancing act, really, for the quants and the tech teams.
It's crystal clear that XVA has just fundamentally reshaped derivative valuation. So stepping back again, what are the biggest implications of all this for the financial world?
The primary consequence, the big one, is that the economic value of a derivative has become truly idiosyncratic, specific to the institution. There's no single universal market-wide risk-neutral measure anymore. Not really. Valuations are now specific to each bank, reflecting their unique business mix, their funding costs, their capital position, their hedging strategies, which actually makes perfect sense, right? Different banks do have different credit spreads, different funding access, different capital requirements. It's like that custom house. Again, its value is different depending on who's buying, their financing, what they plan to do with it. No single market price fits all.
That inherent subjectivity, it does raise a big question. How do banks actually manage these complex institution-specific risks day to day?
It's a mix, really. A combination of active hedging and, well, some risk warehousing. Market risks embedded in the XVA like interest rate or FX sensitivities, they try to hedge those, often with linear instruments like swaps or futures. Though even that's complex, just given the sheer volume of sensitivities. Credit risks, typically hedged using credit default swaps, CDS. But, and this is key, it's virtually impossible to perfectly hedge all the XVA components, especially things like DVA or complex correlation risk between market factors and credit. So there's always some residual risk, some degree of risk warehousing that the bank has to hold and manage carefully. And our sources also point out eligible CDS hedges can actually provide some capital relief under Basel III, which adds another strategic layer to how they manage it.
It really makes you pause, doesn't it? How much finance has changed, how quickly. So what's the final word? What does this all mean for the future of finance, the models?
Look, the paradigm shift is done. It's here to stay. XVA in all its forms, CVA, FVA, KVA, the whole alphabet soup, it's basically about shining a bright light on the true granular costs of being in the derivatives business. And this push for greater realism, it means quants, technologists. They're facing immense complexity now. Those sophisticated but perhaps simpler risk-neutral models from before the crisis, they look almost quaint now compared to the comprehensive multi-layered frameworks needed today. And these frameworks will keep evolving to match market realities. This isn't just some passing trend. It's a fundamental, permanent change in valuation and risk management, a whole new ballgame.
What an incredible deep dive that was, seriously.
Right.
We've gone from a world where Black-Scholes Merton felt like the ultimate answer to this new landscape where XVA is absolutely dominant. We've unpacked how CVA, DVA, FVA, MVA, KVA, how they've completely reshaped derivative pricing, made it this uniquely institution-specific puzzle, driven by credit, by funding, by capital. You've seen how the post-crisis reality forced everyone to grapple with messy, incomplete markets, complex regulations, pushing the boundaries of quant modeling and the tech needed to support it.
Yeah. So what does this all mean for you listening in? Well, the next time you see a big bank's results, remember, behind those headline numbers, there's this massive, incredibly complex engine churning out XVA calculations, shaping their profits, their risk profile. That simple idea of a single, clear market price for a derivative, it's largely gone, a thing of the past for many instruments.
And that leaves us with, maybe, a provocative thought to chew on. If a derivative's true economic value is now so tied to the specific bank holding it, their funding, their capital, their credit, rather than some universal market price, does that fundamentally change how we even define fair value in finance? What does that mean for market transparency, for efficiency? And how might this ongoing shift continue to shape financial markets in the years ahead? Something to ponder, definitely. Maybe take a little